still quite constructive, still pretty bullish. I think, overall, when we look, for example, at the market reaction today, go back 3 months, I think that market reaction would have been very, very different, Very different. It would have been probably a lot more panicky. I think that tariff sensitivity is really starting to go down.
It's like, the boy who cried wolf kind of. I'm not saying Trump's crying wolf. Quite the opposite. These are very real concerns. But the fact of the matter is, how many times can the market worry about the same thing?
But the funny thing is that, for weeks now, people are saying, ooh, but the market is complacent. I'm like, yeah, you said that 10% ago.
Yeah, it's true.
And it's like, well, maybe it is. I keep saying, look, maybe it is complacent, but it is rightly so. Right? Yeah. Because at the end of the day, we do know there is a Trump put. I don't know where it is. Is it after 5%,
it's around
after
about
10%?
4.75% on the US Treasuries, isn't it, on the 10-year?
And we are quite far away from that still. So to me, the biggest risk is still yields. It's still what happens to valuations and so on. And, we're still a good sort of 30, 35 basis points away from what we call this danger zone, right, where basically valuations start to take a hit.
Before the award-winning journalist comes in, morning, Sylvia. Nice to see you.
Today,
what an intro. Yeah, what a great start to my Monday morning.
I haven't won anything since the Proficiency Award as a carb in about 1987.
That's not true. You have an award on your desk that the team gave to you.
The team. So. They're just feeling sorry for me. But in terms of owning this market, I've had Chris Watling from Longview, who, creating a market actually on this show with you and him. He's a bit cautious. You say still own the market, yeah?
Yeah, absolutely. I would be still buying pretty much any dip there is in equities and in risk assets overall. Right. So, we're sort of medium overweight equities. We're particularly overweight US equities, which is very different from the last couple of months, of course, calling a bit more for a US equity outperformance. Almost max overweight, high yield, double overweight EM rates. So very, very risk on. Have been so since really the US-China pause. To me, that was the big, really game changer. Because to me, that really said, look, there not only is a Trump put, but we now know also that sort of the big one is kind of gone, right? The big risk US-China is kind of gone. Of course, what we always need to remember as well is we shouldn't treat this as sort of economically inevitable. This is not like payrolls have gone down 1 million and therefore consumption is going down and therefore, we get this spiral down and therefore a recession is unlikely, is inevitable. No, this is, if by the 1st of August we get there and we're saying, hey, you know what, we've got the world's biggest and greatest negotiations ever. We just need 3 months more time. Cool, we'll delay it another 3 months, right? So that's the thing that I think people are making the mistake to look at. Oh, we look now at the 1st of August as if this is like this most inevitable thing. People did the same thing with last week with the 9th of July, right? Looking at the 9th of July as if this hits and we're going to jump over the cliff. And then the 9th of July was there. It was like, well, actually, now we've got another 4 weeks. Who's to say that in 4 weeks' time, it's not going to be another 2-3 months and we're treating this completely the wrong way, really? Yeah.